We have very disturbed markets over what's happened with interest rate trends, and we have yet to really settle in, to feel very sure about where the range is on long-term U.S. interest rates, where the Federal Reserve is going. How much negative feedback do we need to have in equities markets before we settle into that range? So these are the sorts of things that, again, have left markets disturbed. Then you come in and you have some geopolitical risk being priced into the oil market at a time when markets have not fully come to grips at the moment. But again, a lot of those things will happen.
You said you have questions about what kind of volatility equity markets could see given the environment that we have. That implies that you're not comfortable right now that we have reached a shorter term or even medium term bottom for the market given the volatility.
I don't think people can assume you get a couple day sell off and you are all clear, because again, new factors come into place. I do think that the speed at which U.S. stocks corrected over the course of last week, though, suggested it was going to be over with fairly soon. We have seen this before. We have plenty of concerns to worry about where we are in the longer run, but the speed at which we corrected last week does tend to get it over with fairly quickly.
What types of, this kind of environment does create opportunities, either for aggressively trying to profit from it, or at least giving you a chance to reposition your risk allocations. How exactly, as a strategist, do you then tell your clients how to proceed given the environment that we've seen?
Well, it's stay very much according to an asset allocation, to a real plan. The fact that if you had a positive view of the remainder of the economic expansion, having a cheaper entry price certainly helps, but it's being multi-asset class, and it's really being global. If you think about it, in the course of the third quarter, the United States stock market was the only one moving up. It moved up very sharply. It erased almost all the third quarter gain very, very quickly, kind of put us where we were in other markets. Where we're going from here, we think that markets are overpricing economic risk, at least for the coming year. But we have to recognize that the Federal Reserve is getting tighter late in expansion. If you were a U.S. investor, you have to take a look and say, well, I can get a taxable equivalent yield of 6% in the municipal bond market. You're saying you shouldn't have any allocation. You should only be worrying about the equities tape. That's, again, the reason why to have a risk control, balanced view.